This conference
Start
will
this
now
recording.
be recorded.
So we are actually going to go into lesson 3 today. Lesson 2 is more technical stuff, just setting up the charts, the indicators, and stuff like that. Nothing that you really need me to go over with you necessarily. So I feel like you guys could watch that on your own. I send a video. All my students usually agree that it's kind of you could do that on your own kind of thing. It does have a top-down analysis portion that I do think is very, very important, but that's half the portion. Most of the portion is the indicators and setting up your charts. And because people set up their charts differently from others, as in a means to how fast they are, sometimes the class could go really slow waiting for others. So doing it on your own is going to be at your own pace. You can set up your charts on your own time, and you don't have to be rushed for anybody. All right. If you have any questions on that, you let me know. But today we're going to go into lesson 3, which is support and resistance. All right. Before I go into the lesson 3, do we have any questions of lesson 1 or any other homework that we had to do, any of the contracts or any of the assignments that you guys had to do? Any questions on those? No? All right. Sounds good. So support and resistance. So support and resistance is basics of technical analysis. So number 1, the market is always right. The current price action of any equity takes into account all public knowledge and information about a stock. Current price action represents past earnings and an expectation of future earnings potential. As more information comes into the public knowledge through news and filings, it is immediately incorporated into the stock price almost instantaneously. Technical analysis is the study of price action, price moves in trends and patterns. Ever heard the saying, the trend is your friend? Well, that is because the trend will stay intact until something affects that's the stock or breaks its trend to change it. So do not fight the trend. Always go with the trend. Number 3, history repeats itself. Technical analysis is basically a visual representation of all market knowledge and belief, which is controlled by human psychology. People respond to changes in the market prices the same way today as they did the last situation of the market was experiencing the same similar situation. First thing to do when looking at a stock is number 1, define the trend. What is that trend? We're going to learn about trends today. Is that trend up? Is it down? Is it sideways? Okay, defining the trend enables you to understand who is in control. Is it the buyers? Is it the sellers? Is it the accumulators? Who is in control? Remember, don't fight the trend. The trend is your friend. The trend is determined by analyzing a stock price on a chart. Stocks are like waves with ebbs and flows. Ebbs and flows from recurrent and arithmetic patterns of coming and going, or decline and regrowth. Think of the beach and how the waves move away from the land, the ebb, and then move back towards it, the flow. Meaning stock can rally higher and then pull back, creating a peak and trough. Okay, just like waves. Equities also trend by making higher highs and higher lows, which are ebbs and flows, and lower lows and lower highs, just as ebbs and flows. They are also make equal highs and equal lows. Now, this is considered consolidation. So what moves the market? What creates these trends? Well, that would be buyers and sellers, or more importantly, supply and demand. The more buying pressure, aka shares in demand, the higher the price. The more selling pressure, aka shares being sold, the lower the price. So the more supply that is being pushed in the market of that particular stock, the lower the price, because it's going to continue to find buyers. And if it can't find buyers at that price, it's going to go lower to find more buyers to satisfy that supply. Same as in the demand. If there's a lot of buying pressure, if there's a lot of demand, prices are going to increase, and they're going to continue to increase until that demand fizzles down. So we take a look at the types of trend directions here. So here we have an uptrend. We have a low that's established, and then we have a high that's established. Then we have another low that's established, and then we have another high that's established. All right, we have an uptrend. Now, uptrend is a series of higher highs and higher lows. So we have one high here, we have one low here, we have one high here, we have one low here, and we have one high here. That is an uptrend, and we continue that uptrend up. Now, how do we define the lows and the high? Well, to define the low and the high, we have to look at those three candles, right? In between three candles, we could see this candle, this low, is the lowest candle of these three. And then we start going up, and we go up to this candle, and we see this candle is the highest candle of these three. Okay, and then we see that this candle here is the lowest candle of these three. And then we come up here, and this is the highest candle of these three. All right, so that is how we distinguish our lows and highs. Okay, and now for the downtrend, which is selling pressure, right? So an uptrend is buying pressure, shares in demand. A lot of people want this stock. A lot of people are accumulating this stock. So the price is increasing to kind of wheedle out that demand. Now, because there's only a limited number of stock, right? They can't just give everybody all the stock that everybody wants at one price. Okay, there's a limited number of stock. So the more people want it, the higher price it goes. Now, downtrends, we see a series of lower lows and lower highs. So here we have a high, and then we have a low, then we have a lower high, we have a lower low, a lower high, a lower low. So we have a series of lower highs and lower lows, creating a downtrend, which is selling pressure. There's too much supply here, so then the market's going to go find areas where there are buyers that are going to meet up with this supply because somebody's trying to get rid of this stock. Okay. Now we have sideways consolidation, or AKA box consolidation, where we're making equal highs and equal lows, and that means buyers and sellers are pretty much equal, right? So downtrend, sellers are in control. Uptrend, buyers are in control. Sideways consolidation, buyers and sellers are equal. So always remember, there's always going to be three directions: up, down, and sideways. Always. It's going to be one of those directions: up, down, or sideways. Now, accumulation and distribution. Now, this is what makes a market, right? Supply and demand, accumulation and distribution. So accumulation and distribution happen because of very large orders. There are institutions or very wealthy people, nations, or pension funds that need to purchase very large orders. These individuals cannot just open a brokerage account and submit their trillion-dollar order. They must go through a market maker such as JP Morgan or Goldman Sachs. Then they purchase the shares orders over a period of time. And that is what creates actual support and resistance, supply and demand zones, because they can't just say, oh, I want you to sell all of Apple right now. They can't do that, right? They're going to control that. They're going to have too much of an effect on the overall market, then it's going to have a major consequence. So to prevent that influencing the market, they spread out their order and distribute it over time, or accumulate it over time. Because if they just bought Apple one day, $1 trillion they want, Apple, or $1 billion, whatever it is, it's going to affect the stock. It's gonna manipulate the stock. right? It's going to increase it rapidly. And they don't want that kind of market manipulation. So here we have accumulation. So when a stock is consolidating sideways, the price is being restricted in a range to either sell shares or purchase large orders. In this, if the resistance is broken to the upside, that means that there's a large order placed, and now the stock will increase in value. Okay, why? Because there's less shares in holdings because somebody has accumulated most of the shares. So the remaining shares have to increase in price for the demand of everybody else. So here we have accumulation. It breaks to the upside and we rally. Why do we rally? Because there's less shares outstanding, which is going to leave everybody else wanting to bid up the stock just to buy it because they see it's breaking out, it's playing a breakout, whatever, and the price is rising. The market makers are increasing the price because all the demand is getting there, and there's not enough shares to go around. So they're going to give the remaining shares to the highest bidders. Okay. Now, distribution is when a stock is consolidating sideways and the price is being restricted in a range to sell shares. Okay, now after all these people have accumulated all these, right, all these shares, and then it goes up, triples, quadruples, whatever it does, and then it starts going sideways, then they're starting to take profits. They're like, we already made 3 times or triple our money. We're going to distribute our shares. Okay, and then once that starts distributing, right, we have a sell-off. Why? Because now all those shares that they picked up, they're selling. So now they have to find buyers for those sellers. And now the price is going to fall to meet that demand because there's not going to be as many buyers up here as there were down here. So we also have a back test and confirm right here, which we'll go over in a little bit. But here we're in this box, and then we bounce and then break through and then test that support area that it bounced on at first, and then confirm that that is seller's territory, and then we sell off. Okay. Now supports. Now we have horizontal support, which is levels on a chart with buying pressure. The areas need to hit and bounce at least 2 to 3 times on these supports to be considered good supports. So an example here, 171 and 166 area were good support zones. So here, bounced off here, and then rallied up, bounced off here, rallied up, bounced again, rallied up, formed a little W pattern and rallied up. All right. And now we have horizontal resistance. So levels on a chart with selling pressure. Now the area that hit at 220.30 needs to hit at least 2 to 3 times to be considered good resistance. Here we hit 1, 2, 3, 4, and then sold off. Okay. Now past support and past resistance become support and resistance. So past support becomes resistance. So the same support here at 171 and 166.50, we have that same support right here, 171, 166.50. Now here, it bounced on that support, and it was a small bounce, and then it broke through, and then it came back, tested that resistance, came back, tested that resistance, came back, and then confirmed it's down. So that became resistance down. As it was support, it became resistance, and it confirmed it. Now the same thing happens with support. I mean, resistance becomes support. So here, this was resistance. It hit resistance here, came down, hit resistance again, came down, hit resistance again, came down, hit it again, came down, and then finally on the, was that 1, 2, 3, 4, 5, fifth try, broke through it with the big candle, and then came back tested it, and confirmed it was support and started rising up again. So past resistance becomes support, and past support becomes resistance, right? So now we have uptrend line in a diagonal support. So we have higher highs and higher lows making a uptrend, and then we could put a support line right there that's going to respect that uptrend. And then we have a downtrend line, which is diagonal resistance, which is going to respect this line as resistance because there's sellers there. There's buyers on this uptrend support line, and there's sellers on this downtrend resistance line. Now we have bullish and bearish channels. Now, channel is created by support and resistance steadily making higher highs and higher lows. So here with the bullish channel, we're uptrending, but we're in a controlled bullish run. So we have buyers here and we have sellers here. So we're in a controlled bullish run. We can't exceed each side. If we do, that's a breakout. Bearish channels as well. Bearish channels create support and resistance, steadily making lower lows and lower highs. This price action is in a controlled bearish run. So too much supply, and market makers are controlling it, stepping it down. So most important thing that you need to know about the market and the price action is impulsive and corrective moves. So impulsive and corrective moves, we're going to go through that, whether you know the term or no, we're talking about the term throughout the course. And you're going to deal with impulsive and corrective moves every single day because that is what the market is. The market is strictly impulsive and corrective moves. So the market doesn't go straight up or straight down. It moves in impulsive and corrective moves. So impulsive moves makes a big push up or down. Corrective moves make a smaller push down or up depending on the impulsive move, usually 1/3 of the impulsive move up or down. So here we have a nice big impulsive move, and then we have a corrective move, and then we have another impulsive move, and then a corrective move. And we'll go over more in depth of impulsive and corrective moves in our patterns lesson. So this was like the basics of support and resistance generally, and then we're going to go into our pre-market high and low, our lower time frame support and resistance, and our intraday support or resistance. So pre-market high and low for our intraday charts. So pre-market high acts as resistance level. Once the price breaks that pre-market high, it usually continues to trend up and push prices higher. A good bullish sign of higher prices is if the pre-market high is broken and held to the upside. So here we have the pre-market high, and we broke out, and we're kind of consolidating on it, then got on it, held it, and then pushed up. Okay. Then we have our pre-market low. Our pre-market low acts as support, but once it breaks that pre-market low, it usually continues to trend down and pushes price lower. A good bear sign of lower prices is if the pre-market low is broken and held to the downside. So here we broke that pre-market low, got above it, try to hold it, broke it again, try to get it, couldn't do it, and then fell off and then continued down. Now, if you're in between the pre-market high and pre-market low and you're not breaking either of them, most likely you're going to consolidate in between them, and it's going to be a choppy day. Now, intraday, from your 5 and 15-minute chart, the open and close of the first candle of the day, whether that be on a 5 or 15-minute chart, is very important for the day, whether that be for day trading and or direction. closing above the open close of the first candle. This can show a bullish direction once the candles clearly close above the opening close of the first candle. Then we can assume there's direction to the upside. Once we can assume price will make higher highs, not lower lows, we can enter into our bullish positions. Using the open close as a stop loss if the price returns and closes below those levels. So we can exit, as we do not want to be in our position if we're not making higher highs anymore, but lower lows or even consolidation. So here's the first candle. It opened at 335.23. It closed at 337.19. The second candle held the close of the first candle and closed above. Okay, so that tells you the direction is currently up as we're making higher highs and we held the close of the first candle. So here you could enter a position if you liked and use 337.19 as a stop loss. So here, if you would have done that, it would have been great because it continued to trend up right after the second candle started to trend up. Now, having the open and close of the first candle and then closing below the first candle, this is going to be a bearish direction. Once the candle clearly closes below the open and close of the first candle, then we can assume there is direction to the downside because it's going to be making lower lows and lower highs. Not higher highs and higher lows, but lower lows and lower highs. This is important, guys. This is important throughout all of our trading stuff. Some of you are probably like, well, this is basic. It doesn't matter because most of your problems is just going back to the basics. Okay? Higher highs and higher lows is uptrending and it's bullish. Lower lows, lower highs is bearish and it's downtrending. Okay? So once we could establish that we're going into a bearish trend with lower lows and lower highs, we can enter our bearish position and use that open of the first candle as a stop loss. Okay? Because if the candles come back and get above that open of the first candle, then that's going to tell us, hey, we're not going to be making lower lows and lower highs anymore. We're actually going to come back up and see if we're going to test those previous highs. Okay, well, I don't want to be in a position right there because I want to be in a trending position. I don't want to be in a consolidation. A consolidation is going to be making equal highs and lows. I don't want that. I want either lower lows and lower highs, or I want higher highs and higher lows. Those are only two things I want. I don't want sideways. It's no money there, right? Unless you're selling options, that's not what we're doing here. All right. So we have there 341.17 is open, closed below it. The first candle was inside of it, so we wait. Third candle, close below it, we enter our position, and then we use that as a stop loss, and it continued to go down, and then went sideways, and then came back up, and then came down, but never revisited that stop loss. Okay. Now, same intraday, 5 and 15 minute. What's important that we have to establish is the day's high and the day's low. They're very, very important. Now, whether you're on a 5 or 15 minute part, it's very important for the day that you establish the high and low of the day. Now, when I say the high and low of the day, I don't mean the high and low of the complete day, because you're not going to wait till the day's over, then find these and then want to trade. Okay. You find them as the first high and low of the day. So they are the first high and low of the day that were established. Now, what did I tell you earlier on how to establish those highs and lows? With 3 candles, right? So here, a general rule is the first candle of the day will be either your high or your low of the day, unless there's an engulfing candle that appears second that is completely larger than your first candle. Okay, completely engulfs your wicks and everything. Okay, or your first candle is so large that your next 4 to 5 candles are within the range of the first candle. Okay, then your first candle will be your high and your low of the day. Okay, but if there is no engulfing candle, or the first candle isn't a large candle with the next 4 to 5 in the range, then you must establish a high or low on the first candle. Wicks are included. So here we see, how do we find the high? Well, the way you find the high is it is the highest high in the trend. The first highest high in the trend, which is out of what? 3 candles. Why? It's like it's on a pedestal between the other 2 candles. So we made a high, higher high, higher high, and then a lower high. Okay, this one is our high. Okay, same thing with the low. The way you find your low is it is the lowest low of the trend out of 3 candles. Okay, so we have a low, a low, a lower low, and then a higher low. So that is going to be our low. Okay, so notice the first candle's wick is the low. Okay, because the second candle made a higher low and a higher high. Now, the third candle made another higher high. And now the fourth candle made another higher high. Then the fifth candle made a lower high. So the fourth candle is our high. The first candle is our low. Fourth candle is our high. Because the first candle made a low, second candle made a higher low and a higher high. Third candle made a higher high. Fourth candle made a higher high. Fifth candle made a lower high. Therefore, our fourth candle is our high because it is higher than the fifth candle and it is higher than the third candle, making it the highest high of the trend. Now we have our day's high and our day's low. Okay, our day's high and our day's low, or our first high and our first low, are very important because that's going to set our mood for the trading day. So see here, after we established this high, we drew the day's high. Now the day's high is going to become breakout point for bullishness. The day's low is going to establish breakdown point for our bearishness. Now why? Okay, let me see if anybody of you are getting this. Can anybody tell me why the day's high would be established for breakout for bullishness?
Would that be the day's resistance?
Support, no? Be support.
Nope, nope.
What was that question, Steve?
Said now why would the day's high be a breakout point for bullishness?
It looks like it makes a bull flag.
Well, if you, based on earlier, you said that you draw your initial support and resistance from the pre-market, right? and then you so if you based on that, that would be your breakout because it's okay. So it breaks it breaks that uptrend. It creates another trend, right? It starts another trend from that high of the day.
So what it's what I've covered all day today, guys. Remember I said it's important.
Buying pressure.
Steve,
What is it?
I think
Buying
the answer to the question is it's forming a higher high.
Exactly. Exactly. Very simple. The reason why that's breakout is because that's the high. So if it breaks above that high, guess what? It's forming a higher high. So if it's forming a higher high, then that means it's bullish, right? Because bullishness forms higher highs and higher lows. So if we're breaking the previous high, then we're continuing that bullishness as we're making higher highs. Now the same thing goes for that day's low. If that day's low is broken to the downside, well, now we're not making higher highs or higher lows. We're making lower lows and lower highs. So if we break that day's low, we're going to be in a bearish breakout because we're downtrending, making lower lows and lower highs. Okay. So remember, that's why I said, even though that stuff may seem basics, you got to come back to them because that's the necessities, right? We're always going to be coming back to it because that's all it is. We all want to be trending. We want to be trending up. We want to be trending down. Okay. Making higher highs and higher lows, that's trending up. That's very bullish. Trending, making lower lows, lower highs, that's bearish. So we want to be trending one way or the other. If we're just going sideways, making equal highs, equal lows, we don't want to do any of that because that's sideways consolidation. You're not getting any direction. All right. So here, notice again that the first, sorry about that. Let's see here. All right. Notice again below, the first candle's wick is pretty high, and the second candle, the first candle's wick is pretty high, and the second candle, the wick is lower, but also the second candle doesn't break the low. So it doesn't make a lower low. It doesn't make a lower low, and it doesn't make a higher high. Now the third candle does make a higher high, and then the next candle, the third candle, makes a lower high. So because the third candle makes a higher high, automatically the first candle is our day's low. Okay. Now the third candle, because it made a high and the fourth candle made a lower high, that means our third candle is our day's high. So here we had our sixth candle come and break above our high, but then our seventh candle came back inside and rejected that high and sold off hard, and then broke our low, and then came down and then hit that day's low and just chopped around and consolidate on it. Okay. So these levels are important, guys. These levels are important. And I will go into the charts right now. I'll show you why they are important. Let me get my charts up. Let's see. Okay. All right. Let me see if this is too big for everyone. All right. So, does somebody want to give me a stock to go over all this with?
Nvidia.
Oh, was that NVIDIA?
Yes.
AMD, NVIDIA? All right, NVIDIA was the first one. So I'll do NVIDIA. All right. NVIDIA. All right, NVIDIA. All right. So let's start with this basic monthly chart because we always start from the top, and you'll go over that in that lesson too. We always start from the top. We always start with top-down analysis. We always start at the highest possible level that we could go, and honestly, the highest possible level we could go is the yearly chart. So the yearly chart doesn't really do much sometimes. Sometimes it does, but majority, we just start with the monthly chart because that's going to give you the overall general idea. So based right off this chart, what do we see?
Uptrend.
Uptrend, right.
Creating higher highs.
Right, exactly, right? So this was the previous high here, okay? And this was a previous low here. This was a previous low here, okay? So we stopped here, we came down, broke this low, okay? Then consolidated going sideways, making equal highs, equal lows. And then we got back above this previous low, as that previous low was being resistance, got back above that previous low, and then broke this previous high here, right? Go up, broke that previous high, but failed to get above it and close, came back down to this previous low, and then came back up to test this previous high again, and now we're breaking out of that previous high, making higher highs and higher lows. So we made a low here, a low here, made a high here, made a low here, made a high here. So now this is making higher highs and higher lows, which is creating an uptrend, okay? So right off the bat, basically, NVIDIA is in an uptrend, making higher highs and higher lows, okay? Very simple, right? All right, we did some support and resistance, right? We had resistance here at this high. We broke out of that high. So now that we broke out of this high, what is that?
Support.
That's
Support.
the new support.
Well, yeah, it could be a new support, but what's it called when you break the previous high?
Breakout.
Right, broke out. So broke out. So it broke out, creating more highs, higher highs, right? Let's go to another time frame. So as we go to lower time frames, the picture gets a little bit more information. So now we see that we had a previous high here, right? Previous high here. And we came up here, made a high, and then made a low. But this low was higher low than this low. Then here we broke out of this high here. And then also today, which said today was an important day for NVIDIA, it broke this previous high here. Now, can anybody tell me why this is the previous high?
Because the next candle is low.
Exactly. So we have a high here, a high here, a higher high here, a higher high here, and then this candle as a lower high. So that means this is the high of the trend. The low of the trend is going to be actually this one, this candle here. Why is that the low of the trend? Because this candle here, this low here is 280.84. Oh wait, 280.84. Maybe that is 280. Okay, so by 4 cents. So this is actually lower by 4 cents. It looks like this one's lower, but I guess that wick pops out just a little bit. So then our low of this trend, is actually here. Okay. All the way down here because all these are higher lows. All right. So there's the high as this is the lower high. That's the lower high. So this today has broken out of the trend. But very, very important and key thing is that we always have to wait for the candles to close because it doesn't confirm until it closes, because just like this candle broke out this high but then came back and closed underneath that high, the same thing could happen there, and that's going to be a fake breakout, right? So we need a push higher to break out of that previous high. All right, so just like this was the previous high. It broke out of that previous high and closed above. That's good. As long as it stays above that previous high, this should be going higher. Now, does anybody know why this should be going higher if this stays above this previous high?
Creating higher highs and higher lows.
Exactly, because it's going to be creating higher highs and higher lows. Because why? It's in an uptrend. Because it's in an uptrend. So if it's in an uptrend, it should be creating higher highs and higher lows. All right. So now that we went over some support and resistance here, let's go over a little bit more support and resistance here. So here we have a box consolidation as well. So we have box consolidation here, equal highs, equal lows, just going sideways, right? We don't like that. Okay. Now once it breaks out, what is that?
Breakout. Or accumulation.
Yeah, accumulation, right? Because it breaks to the upside, right? Yeah, so it's going to be accumulation. So if it's really accumulation, we want to see continuation where?
Uptrend.
Okay.
Exactly. If this is accumulation, this has been accumulating for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 days. So this accumulation for 16 days is not going to just pop 20 bucks, 30 bucks, and then fizzle out. This accumulation is saying, hey, they're accumulating all these shares. We should pop and start running. Okay. So this accumulation should make us push higher. Now, if we break back inside, then that's going to be a weak accumulation and it's going to fall back and it might even break down for a fake breakout to get trap people that are thinking that it's accumulation and then break down. But if it continues and has another candle close above this high, right? Then that's what? Another higher high. So then it's going to start uptrending and start pushing up higher. So that is accumulation breakout. And then from what we actually charted earlier, it's in a bullish channel, controlled bullish channel, and it has more room to the upside. I could consolidate maybe a little bit, make a little bull flag, and then fire up, but it looks like there's least resistance to the upside. And especially, right? So in your second lesson, we're gonna go over, you know, top-down analysis and have your biases. And our biases are gonna establish from our biases are gonna establish from our top-down analysis, and our top-down analysis are gonna establish from looking at higher time frames and working ourselves down. So we'll look at the monthly chart and we'll see, okay, we broke the previous high here, closed above, right? So clear that again. Clear this, all this. So we broke that previous high and closed above, and we broke this previous high, closed above, making higher lows, making higher highs, we're continuing to make higher highs. We're in an uptrend. We've already broke out of this trend, right? So this long trend, we broke out of that trend. So what's that called? That's called a trend continuation. So if we're in a trend continuation on our monthly chart, which is a higher time frame chart, which signifies, you know, a larger pace, a larger movement, then we could establish that these highs that are broken, we shouldn't come back and visit them anytime. We should continue making higher highs. All right. And then our daily bullish channel, right? Our daily bullish channel signifies that we should continue higher. Why? Now, why should this bullish channel continue higher? Anybody know?
It's gonna respect that. It's gonna respect that channel.
Why?
Because it's on a bullish uptrend.
But what's the saying?
I think it's starting to distribute.
Your trend's your friend.
Exactly. The trend is your friend. And what is the trend right now?
Bullish.
Uptrend.
It is up. The trend is your friend. Do not fight the trend. Okay? The trend is your friend. All right? So we already have this consolidation. We already say that we're going in a accumulation breakout. The trend is up. The monthly, the weekly, the daily, it's all saying it's up. We're making higher highs. Everything's up. Now, why would we be bearish here when everything is saying it's up and the trend is our friend? Now, when this 20-day, right? When this 20-day, which is lining up right with our trend, when that is broken, all right, the trend is our friend and the trend is down. Okay, but here, trend is your friend, the trend is up. All right. All right, so let's go into intraday. Let me clear all this here. Let's go into intraday. All right, let's go a couple days back. All right, we'll go all the way back here. All right, we will get our pre-market low. It's gonna be right here. Okay, we're gonna get a pre-high. So let's just do that. Pre-low. Okay. So we got our pre-low, pre-high, and then we go into our day. The first candle was a huge candle, and the second candle made a higher high. So right after this candle, so let's even go here. So right after this candle has formed and made that new high and closed, we establish our first candle as our day's low. So that is our DL, which is our day's low. So that is our day's low. Okay, now the second candle, third candle, fourth candle, fifth candle, and fifth candle's high 350.34. Okay, sixth candle's high is 350.42, and then the seventh candle is the lowest or lower. So this candle is going to be our day's high. Okay. Day's high. All right. Now our first candle, we have our open here. So that's going to be our open. And then our our first candle's close going to be here. That's going to be our close. All right. So there we have our open and our close of our first candle. So we have a push up. We hit our day's high, we established our day's high here, and then we came down, hit our close of the first candle, and started consolidating on our close of the first candle. And then at the end of the day, it broke that first candle close, and then came all the way down back towards that open and kind of just stayed right there. All right, didn't really do much there. Okay, popped up, respected the levels, and then fell back down and almost hit our open, and then came back up. Now, does anybody know why I focus so much on having you understand why you have the open and close of the first candle and why they're so important? Well, the reason why is because the first candle of the day has the highest volume out of the whole day. So whatever it is, buyers or sellers, there's going to be the majority of buyers and sellers in this candle. So at the close of it, there's going to be support. At the open of it, there's going to be support. And there's going to be resistance as well. Okay, so they're going to be strong support and resistance areas because they're the highest volume of the day. The candle's the highest volume of the day. All right, and that's why you focus on that open and close. All right, let's go to the next day. So let's grab this pre-market low. So pre-market low is going to be here. The pre-market high is going to be here on this candle. Pre-market low is on this candle. Open's gonna be here. Oh, oops, wrong can. This one. Pre-market high is here. Okay. Close of the first candle. All right. So I got the open of the first candle, the close of the first candle, pre-market high. Okay, and then day's low is the first candle because the second candle is higher, and the third candle is lower. So then the second candle is our day's high. All right, so I got all of them. Pre-market low is going to be this one here, right here. That's our pre-market low. All right. So now we have all our levels. We have our pre-market low, we have our day's low, we have our day's high, we have our open and our close. So now let's see what happens. All right. So we have pretty much consolidation inside our open and close of the day. We pretty much consolidated in there. We try to get above the pre-market high and the open on our first candle. I mean our second candle. Then we got rejected with the big rejected candle, and then we came and consolidated. Try to get above again, failed, and try to get above again, failed. Now, very, very interesting. Okay. Does anybody notice anything that really stands out to you right here?
Is it a box consolidation?
It is a box consolidation, but it's doing something very interesting that you would notice if you were really paying attention in the key areas of the class today. It's making very, very important, doing something very
It
important.
touches that level 4 times, I believe.
Yeah, trying to check the resistance or support.
It's a hard resistance.
Right. But after this candle, right, because this is a hard rejection candle, and this pretty much, wipes everything clean. So this opened, this pushed up, and this kind of gave all that back. Everything that it did, it gave it all back. And then from this candle on, it does something interesting.
Everything is within that first candle, that big candle. Everything else is below its high and above its low.
Just choppy.
Yeah, it's super choppy, but it's giving you one key hint.
Buyers are
It's consolidating, but it's slowly uptrending.
And what's that called?
Breakout?
in pressure.
Following 20 SMA.
That accumulation?
No. What kind of trend is that?
It's bullish uptrend.
It's uptrend, exactly. Why is it uptrending?
Higher high and lower, higher high, higher low.
Exactly. So even though it's going sideways, right? Even though it's going sideways, it made a high, a low, which was higher than this previous low. Then it made a higher high, and then it made a higher low, and then a higher high, a higher low, a higher high, and that's when it broke out. It broke out on that higher high. So it was making higher highs and higher lows the whole time. They were very tight, consolidated ones, but it was still uptrending, right? It was giving you that hint, that slight hint that even though it was stuck in this consolidation, the buyers were telling you, we want to push this up. The buyers were telling you want to push it up here, and the sellers said no. And then here, the buyers were telling you, we want to push it up. We want to push it up. And this higher highs and higher lows was evident. And then it pushed up, made a new high. Here, came down, made a new low, but then never closed below this uptrend, and then broke our day's high. And once it broke that day's high, it rallied up. Why? Because once it breaks that day's high, it's making higher highs, and it's a breakout. That day's high, once you break that day's high, it's a breakout. It already broke the pre-market high here and here and here. And then that day's high, that was the trigger. We're having a breakout. Boom. And it rallied up. Okay. So, little things like that, you notice, that's why I said you got to always come back to that basics, right? What are you doing? You're making higher highs, higher lows. You're making lower lows, lower highs. And what's going on? What's going on? What's happening? 'Cause that is the key of trading. What is the trend? The trend is your friend. Higher highs, higher lows, lower highs. Which one are we doing? Are we doing equal lows, equal highs? We really weren't doing equal. First, we were doing equal here, but then it started to do higher highs and higher lows. And then once it broke that pre-market high, as this one got back in, this one broke out, and then this one held it, that was it. It was its signal that it's gone. And the volume increased as well. All right, let's go to the next one. Pre-market low. Move that here. Move that here. Okay, let's go. All right, so pre-market low here is going to be this guy. Pre-market high here is going to be this guy. All right, day's low, possibly this guy. Day's high, maybe, let me see. Yep, all right. Close is going to be here. And then open is going to be here. All right, so this candle is a situational candle where we have the candle so large that the next 4 to 5 candles are inside its range. Okay, that means that the first candle's high and low are going to be the day's high and the day's low. Now, when this happens, we don't like this because that pretty much says we're going to be in consolidation, making equal highs and equal lows, because the first 4 to 5 candles can't even break the high and low of the first candle. Then we're making equal highs and equal lows. So that's consolidation. We don't like that. That's no trend. Okay. So let's see how this goes. So here, the open and close, we got, so first, let's move that up a little bit. So first, we were rejecting the the close. We're rejecting that. Then we got in and rejected it again. And then made a attempt over again. And then we pushed up again. And then we tested the open, the open of the first candle. We tested that open and rejected and stayed inside of this range. So it was just a frustrating day because you stayed inside this range all day. And those are never fun days. Okay. Those are just sideways days that you're not really, unless you get the bottom and you get the top, right? You're not really going to do much. So unless you get that bottom and then you get that top, which you can for a short, if you knew, hey, this is consolidating, it's probably going to reject at this area, especially because our day high and our open are so close together. That's a good resistance area that could sell off there. Here, never even got down to this low, but if it did, that could be a good area to buy. But sideways consolidation basically. And we kind of, the market told us this was going to happen because our first candle was so large that the first 4 to 5 candles were in that range. So when you see that, better yet, not even to trade that stock, move on to another one, or go to something else, or take the day off, go do some errands, because it's going to be a lot better than having you frustrated all day. All right, let's go do another one. All right, so let's grab that here. So pre-market low, maybe this one. Let's see here. All right, and then pre-market high is going to be here. All right, so our open and close is going to be very tight. So we have our high and our low, and then we have our first 4 candles inside, our first 4 to 5 candles inside. So our day's low is going to be this candle, and our day's high is going to be this candle. All right, so we got them all. All right, so here is another day that's saying it's going to be, pretty choppy, sideways. Let's see what it does. All right, so initially sells off, breaks the day low and the pre-market low, okay, gets below our day's low, consolidates on our day's low, and then pushes back up to our open close. And then we pop up and close above our day's high. So basically we popped our head out of our day's low, and then we came back up and popped our head out of the day's high. So pretty much not any real movement. But I had told you on the previous one, since you know this is going to be in a range, if you get down towards your day's low, it's probably a good idea to get some calls there, because you know it's going to come back to the mid range at least, because it's choppy. So from the consolidation points, you want to get at the lower end, and then you want to sell at the upper end, right? So you could have made a little bit on that, but still pretty much sideways here, sideways here. Not worth the trade. All right, let's see if we can get one more with actual movement. All right, so the open is here, the close is here, pre-market high is here, pre-market low is going to be here on this guy, and then our day's low, let's see where our day's low is. So our day's high is going to be our first candle. Now our day's high is going to be our first candle because our second candle did not make a high or a low, but our third candle made a lower low. So now the first candle is going to be our day's high. And now our fourth candle made a higher low. So then our day's low is going to be our third candle. All right. So we have our open, our close, our day's high, pre-market low, and our day's low. So here we hitting our pre-market low, and here's our day's low. We come up, consolidate here, come back, hit our day's low, consolidate in between our pre-market low and our day's low, and then we push on up towards our open, and then come back down on our pre-market low and close the day there. So pretty much a nothing burger day again. All right, NVIDIA likes to consolidate. Yep, we consolidated for a while. Consolidated for 1, 2, 3, 4 on that 5th day. All right, so let's
Where's that one with all those greens right away?
This one?
That one right in the middle? Yeah.
I mean, It rallied up, but then it just consolidated for the rest of the day as well.
But you wouldn't
slowly.
get your high until that 1, 2, 3, fourth one?
No, you wouldn't get your high until this fourth one.
Okay.
You wouldn't get your high until that fourth one. But remember, you know, I get this every session. I mean, every class session. You know, you don't have to wait for your pre-market. I mean, your day's high and your day's low. Okay, so don't forget your open and close of your first candle, right? So your open and close of your first candle. So if you already got your day's high, right? You got your open and close of your first candle. Okay. You know, day's high going to be over here, but let's see where our pre-market high is. So pre-market high is going to be right where our actual close of the day is for the first candle. So right off the bat, if you're trading, right? The first candle closes, the second candle closes, you could enter in on this candle and have what? This candle, this close of the first candle as your stop loss. So you enter in here, have your stop loss here. Okay, this rallies up, pushes up, and then starts to, you know, look weak. You could get out here. If you get out here, you're gonna get out at your stop loss, right? Because it's gonna come back here and hit your stop loss. If it doesn't close below it, you could still hold it, but I would probably get out just because of this candle. It's an ugly candle, and the trend is it's still technically intact, but it's really weak. So the trend is higher highs, higher lows. Now this is the first low from this trend, but it's very weak. So it's not a very strong trend. I wouldn't stay in. I would either get out here or here when it was showing weakness. If I got in here and I didn't take profits here, I would get out here or here. Here it bounced up, and then if you didn't take your stop loss here, you would have had to take your stop loss here. And by that time decay kicks in, and you know it's lower than you should have when you could have taken that here. So here, when you close below that level, you take your stop loss, okay, and then it pops up again, and then it breaks down, and then it closes below your open and below your or below your close and below your open, and then it comes back here and then just stays and finishes exact candle of the beginning of the day, closes the end of the day, right in between the open and the close. So ugly day, ugly day. All right. Anybody have any questions on this?
Steve, do you mostly trade on the 5 or 15-minute chart?
I trade on the 15-minute chart.
Hey, Steve, I did have a question. At the very beginning, you mentioned that you go by, 3 candles patterns, but then, so like in this instance, there was the 4th candle that was higher than the 3rd. What if, the 5th candle was higher and so on, where like, where would you draw your line?
So don't get it confused, right? So I'm not going by 3 candles, like it has to be 3 candles. It's basically the next candle that's a lower high. That's all. So when the lower high kicks in, that's the end of the trend. Even if there's another candle after that one that's higher, it doesn't matter. That's the high, right? So for instance here, so let me blow this up. So here we have, a low, and then a higher low, and then a high, and then a lower high. Well, this high is the high, no matter if this candle here makes a higher high, this candle's still the high. Does that make sense? Because this one was a lower high from this one, and this one was higher than that one.
Yes, that makes perfect sense. Thank you.
Okay. All right. All right, does everybody get all this?
In the beginning, you said you could do either 5-minute or 15-minute chart. You just recommend 15-minute chart then?
Yeah, I do. It's a lot less choppier and it's a lot smoother. You're gonna get psyched out a lot less.
Okay.
You could do a 5-minute chart, that's fine. But trading's all about patience. 5-minute chart, any lower time frames you go, 5-minute chart, 1-minute chart, the less patience you're gonna have. Why? Because you're gonna get candles like this, right? You're gonna get candles like this with huge wicks. And a 5-minute chart is gonna have it close below your support. But then 5 minutes later, it's gonna close back above it, right? With the 15-minute chart, it's gonna, act like it's gonna close below it. And then at the last minute, it's gonna come back and close above it, right? So it's gonna do that. And the more time you're trading on, like a 15-minute, the less psych outs you're gonna get. So if you're on a 5-minute chart and it closes below, you're gonna want to take that stop loss. But if you're wait, another 5 minutes or even another 10 minutes, then maybe it's gonna close back above, right? So the 15-minute chart is just a lot smoother, gives you more patience, and allows you to stay in your positions longer, which, that's what you want to do. You want to stay in your positions longer.
Is that what we were using when we were going through the examples?
Yeah, this is a 15-minute chart. When we're going through the examples, we're going through a 5-minute chart on the PDF. But it's the same thing, 5-minute, 15-minute chart. It's just a lot smoother on the 15-minute for me. That's what I use. I used to use the 5-minute chart, never use the 1-minute charts. The 1-minute charts is just they drive you crazy. So I used to use 5-minute charts, and I found that once I switched to the 15-minute charts, my life became a lot easier. I became a lot less stressed.
And is this for intraday trading or?
Yeah, you only use 15-minute charts for intraday trading. You never use them for swings.
What do we use for swings?
You use
Oh,
the
Steve.
hourly chart. Use the higher time frame charts for swing trades. Why do you use a higher time frame charts for swing trades? Use daily, 4-hour, and 1-hour charts for your swing trades. Why do you do that? Because you're not worried about the day. You're worried about the larger pattern, the larger time frame that you're going to be staying in this trade. Intraday, you use the lower time frame charts because you're concerned what's happening for that day. Swings, you're not concerned of what's happening for that day, because no matter what happens on the 15 minutes, it's all about what happens on the 1-hour charts or higher.
When we're drawing our lines, do we include the wick or do we not?
No, wicks are always important.
Okay.
And Steve, I have one more question. I noticed that, so you're doing your pre-market lows and highs like around the afternoon the previous day, and then your dailies like around like 3 o'clock in the morning when they start having some growth in the candlesticks themselves. Is that accurate? Just doing pre-market highs and lows in the afternoon the previous day, and then doing your dailies on the first few candles in like 2 or 3 in the morning when they start having mass.
No, you have to do your pre-market highs right before the market opens, because you don't know what your pre-market highs and lows are until the market's going to open, because that last candle could be your pre-market low.
Okay.
So you can't do your pre-market highs and lows until you're about ready to trade, because you don't know what that last candle is going to do. Now, if it's just going sideways like this, and well, actually, yeah, this was our pre-low, this was our pre-high. So if it's going sideways like this, and you could assume that this is your high and this is your low, but if it changes by that last candle, you got to switch it up. But yeah, I never do my pre-market highs and lows at 2, 3 in the morning. I wait until right when the market's going to open, about a couple minutes before, and then I do my pre-highs and pre-lows.
Okay.
All right, any other questions? All right, cool. Homework you're gonna have is do your open and close of your first candle, your day's low, your day's high, your pre-market high and low. Screenshot that and send it to me. Okay. Now, that's homework number 1, right? Homework number 2 is to go on your monthly, weekly, or daily chart, right? Your higher time frame chart, your monthly, your weekly, or daily charts, and show me a resistance point, right? So here's a resistance point and a support point, right? So here's a support point. Okay, I want to know that you get support and resistance down. And then I want you to also show me, what's that on the daily? What's a good one? Show me a channel. Okay, a channel. And then just screenshot that and send it to me, so I know that you're getting it down. And how to get these channels is you're gonna draw a trend line. You're gonna draw a trend line, double click on it, click redraw as channel. Okay, push it on the other end, and then how to get the middle line is you're gonna double click on the channel itself, click edit properties, and then a box is going to come up, and and then you're going to come down and it says coefficients 0.5, and it says visible. You want to click check on that one. Okay, and then that will pop up. All right. And I'm going to send you that video for you guys to set up your charts just like mine. If some of you already don't have them, it's going to give you, and I'll also send you all the custom codes for the volume average, the momentum studies, and the volume bars. So I'll send all those codes to you guys, and I'll send you that video to set up your charts, and then those 2 homeworks. The homework for the screenshot of the intraday system, and then the screenshot for the higher time frame of support and resistance. Cool?
Good shit, man. Thank you.
All right.
Yep.
Any questions before I end the session?
Yeah, Steve, when we send stuff to you, do you want us to send that in the Facebook group, or do you want us to email those to you?
It's up to you. Some people like to send it in the Facebook group. It keeps them more accountable because everybody else sees it and everybody else kind of comments on it. Actually, that actually just started with my last class. They really like doing that. So, I'm not opposed to it. Or you could email it to me if you don't want anyone to see it, or you just want me to see it, that's fine too. Either way I see it. or you could send it to me personally in a Facebook message, which is also, you know, acceptable as well. That's probably the fastest because I'm more on the messages than I am on the email, but it's up to you. Either way.
And we can pick up any stock?
Yeah, so the second video I'm gonna send you guys, which is I'm gonna send you guys right after this class. I'll send it to you, and you guys, you know, whatever, if you want to watch it tomorrow or Friday over the weekend, whatever you want to do, that's fine. But that's gonna tell you that you have to commit to a stock. You have to commit to a stock of your choice, and that's gonna be the stock that you're gonna be actually building a relationship throughout this course. So you're going to be establishing what this stock does, what the price action does, what the movement does, what it's going to do on the daily, right? What is it going to do every day? What's the price action look like? What are the patterns look like? You're going to marry this stock, right? Call them your spouses. You're going to marry this stock. So I typically would tell people to choose 4 to 5 stocks and stick to those. But what actually I've seen the success of students rise tremendously higher is they choose 1 to 2 stocks and they just focus on those. And actually the results are crazy. So really focus on just 1 or 2 stocks, focus on those, you know, more some, just focus on 1 stock. And that's going to allow you and your brain to actually get everything that you're learning a lot better than it would be juggling around multiple stocks, because your brain is constantly switching over to what's this one doing, what's this one doing, what's this one. When you have one and you're focusing on that one, you're always building off of that one and what's it doing, what's the price action doing, what's this doing, what's this behavior and all this, and then you get better and better and better. So I would really want you to do that more so than, you know, watch a bunch of different stocks. You know, most of the problems that people have when they come here is they have a watch list of like 70 stocks, and I'm like, what are you doing? How do you even watch that? You know, it's not good. Focusing on a very small handful of stocks is going to allow you to do a lot better, because it doesn't matter if you're watching 70 stocks, you know, 1 to 2 stocks could feed you for a lifetime. All right. So remember that. And if you master 1 stock, you can master them all. Okay. But you have to master that 1 stock first. You can't try to jump and think that you could trade anything right off the bat, because why? You have to establish these behavior patterns. You have to build on these behaviors. You got to make them instinctual. You have to establish that. And once you establish that on focusing on 1 stock and building those behavior patterns and these instincts, then those instincts are going to transfer over into different stocks, and it's just going to be automatic. And that's how you become very good. Cool.
So Steve, is there any laundry list of stocks which you recommend so that we can choose from those?
Yeah, I go over that in the lesson 2. So there's a criteria of meeting a stock that you have to pick, and you'll go over that in lesson 2. Sound good?
Yeah.
Hey, Steve, where is the second lesson? Are you going to send it?
Yes.
I missed the first part of the lecture.
Yeah, I'm gonna send it. All right.
Thank you.
No problem.
I have a second.
Yeah, go ahead.
So this question doesn't have to do with exactly what we're talking about, but since support and resistance and trend is the first, I guess, like the first real lesson. I don't have much trading background, but like I've heard some people trade off of momentum and other stuff like that. So have you picked trend to be the first thing on purpose, or is it like universal in trading? Does this question make
It's
sense?
universal. It's universal in trading.
Okay.
Yeah, it doesn't matter. It's universal in trading. That's the first thing you have to know. I mean, if you're going to your friend's house, you know, you need to know which direction you're going, right? That's the first thing you need to know. So you're gonna go choose a stock, you need to know the direction it's going. That's the first thing you need to know.
Okay, cool. Thank you.
All right. Lori, did you have a question?
Yep. Yeah, I'm just trying to add these drawings, and when I pick the channel, it doesn't have that line in the middle, and then the regression channel has the line in the middle.
Don't do that. So
Just the one
pick
with
the channel. Pick the channel. Okay, put it on your chart.
Yeah.
Okay, now hover over the channel and double click it. And then click edit properties. Okay, and then go down where it says coefficient 50.5 and then click visible. And then change the color if you like, because it's probably red or yellow. Change that color to whatever color you want. And then push set as default and then push OK. And then your line should pop in.
Okay. So I have
So here,
3 different coefficients, 0.25, 0.5, 0.75. Oh, I just click on the 0.5?
yeah.
Gotcha, okay.
And then
That's
put
making
save as
sense now.
default.
Okay,
And then apply or OK.
got it. Thank you.
And it should be there. Is it there?
Yep, perfect.
All right.
Thank you.
No problem.
Quick question, Steve. I understand the first candle is going to show the most, or there's going to be the most volume on the first candle, but why was it important to know the aftermarket trading high and low?
Because if you break the high of the pre-market, then it's a breakout. You're going to go make higher highs. So it's important because all the intraday, I mean, not the intraday, but all the pre-market trading happens from institutions, right? So institutions are putting all those trades and orders in pre and post market. So if the pre and post market high and low are broken to the upside or downside, that means the institutions are trading that way, typically. So that means if you break the pre-market high, typically that means institutions were buying, you're going to continue higher. If you break the pre-market low, typically means institutions were selling, so you're going to continue lower.
Got it. Thank you.
Mhm.
I had a quick question.
Yeah.
So during intraday, like previous resistances, right, and supports, does it carry over to the next day, or would it affect it?
Intraday, I don't do that. No. I mean, they'll respect it, but you're gonna have too many lines on, and you don't need them.
Okay. All right.
For your higher time frames, like your monthly, weekly, and daily, sure, because they're not gonna be so congested and be all over the place. And you only want to do your current in effect trend, right? So here, my current in effect trend is this one here, right? A low, a high, a low, a high, a low, a high. This is my current in effect trend. So what are my support and resistance going to be? Here's my resistance. Here's my support, right? I have another support here. And that's it. That's all I need to do. Why? Because this is my current in effect trend. I don't even have to do these support and resistance because my price is near here. So do I think it's going to go all the way down here to 320? Well, that's going to be, $50 drop. If it does, I'm going to need that. But Do I think that's likely? I'm going to have a $50 drop? No, I don't think it's likely. So I don't need to worry about any of these previous support lines after this one, because these are pretty strong support here at 347 and 335. Those are pretty good, strong supports. Unless they break, then I'll worry about these ones. But until that, I don't have to worry about any of that, because I'm just worrying about my current in effect trend, which is here. Does that make sense?
Yes, thank you.
Hi, Steve. Can you show one more time how to draw those channels, please?
So you grab a trend line, click redraw as channel, then click on edit properties on the channel, right? Hover over the channel, click edit properties. So then you bring up a toolbox that looks like this. You're going to go to visible and you're going to click the 0.5 and make sure that it's checked. Okay, change the color if you want. And then you're going to put save as default. And then you're going to push OK. Once you do that, you have that middle support resistance line.
How did you get your outer two lines blue? Mine are black.
So you click on edit properties, right? And then you go to curve properties and change those to blue, or change those to whatever color you want.
Oh, okay.
So right here, curve properties and color, right there.
Okay, now mine looks like yours. That's good.
Okay.
Steve, will those be covered in your setup? Because and how long would it take to set it up?
Set what up? I just set it up for you.
No, your setup. You said you're gonna send on lesson 2 how to set up, I guess, our charts.
Yeah, that's all gonna be said there. It's all gonna be set up.
Hey, Steve, got a quick question for you.
Yep.
So obviously there's like, a bunch of these studies that's out there. So out of the ones that, what you have currently on your chart, is that the one that you worked with the most and you like the most and has worked out well for you? Is that what it is?
Yeah. I try to keep everything as simple as possible. And these are the ones that, tell me everything I need to know. Momentum, pace, buyer seller, discretion, where there's a possible bottom, everything I need to know.
Okay, great. Thanks.
All right, any other questions, guys?
For the channel, it should have 3 bottom touches.
2 to 3. So if it touches 2, that's fine, as long as it looks like it's in a channel.
But it
right?
might not touch the top. It might just be close on the top. Or does the top have to touch too?
The top has to touch certain areas, right? It has to touch. Yeah, it has to touch. If there's nothing touching on the top, it can't be a channel, because
Okay. So at least 1 or 2 touches on the top.
yeah, it's the same rules for the support and the resistance, right? Support 2 to 3
Okay.
touches, resistance 2 to 3 touches.
Okay. Thank you.
Any more questions, guys? No? All right. All right, I'm gonna stop the recording here.